Alright, today we're going to be looking at Oddity Tech, which is an Israeli-based beauty and wellness company. As always, if you want the document for yourself to kind of look through in your own time, you can go grab it down below in the description. So essentially what Oddity are, as I kind of mentioned, is a beauty wellness tech company. So they specifically sell skincare, makeup and then wellness products through its DTC platform, which just basically means direct to consumer. And essentially then they use data users, so basically their customers, and when people go on their website to then kind of predict consumer behavior and then utilize this information then to then kind of like release new products and always be like one step ahead of competitors in terms of consumer trends. So it's quite an interesting concept, to be fair, and it's kind of basically been reflected in their numbers. So as you can see in Q1 2025, they did around $268 million in revenue, which was up 27% year over year. They have incredible margins, so gross margins of around 75%. And then they made an adjusted EBITDA of around 52 million as well. So they're also profitable, which is quite rare for quite a young tech company. And I guess one of the benefits of their business models then is that it kind of eliminates the retail middlemen. So like I said, they sell directly to the consumer, which then obviously allows for the really high margins, which is really good. So obviously we've got some comments here on the sector overview, which again I'll let you guys read and in your own time. And then competitors, as you'd guess, so it's kind of broken down between two primary ones at the moment, which is the legacy beauty giants, which obviously all the ones that you know, so like L'Oreal, Estee Lauder, P&G, and then some more direct competitors, specifically in the beauty tech space, will be things like Glossier, Tula, Curology, and basically all these companies are actually, I'm pretty sure, are privately traded, so they're not actually publicly owned yet. As we'll get on to a bit as well, there's also another future brand. So there's going to be a brand 3 and a brand 4. And the brand 3 will be in the telehealth space, which is kind of similar to Hims and Hers, or Ticker Hims, which I think we've looked at already. In terms of their future outlook then, so they're forecasting again another year of 20 plus revenue growth, which is always really good to see, especially with these kind of growth companies. Good EPS guidance, and like I said, they have these two new brands coming out. They're also finally looking to expand into Europe, so France, Italy and Spain specifically. And then they have a really strong balance sheet, so again $250 million roughly in cash. Well, it's kind of coming down to 187 now, and then not much debt either, so I think it was around $24 million in debt at the moment, so really strong balance sheet as well. In terms of the challenges they face then, obviously there's the margin compression. So as they do new investments and do new initiatives, margin is expected to come down. It'll be very tough to kind of maintain a 75% margin. And then obviously, as we all know, there's quite intense competition in the beauty industry. There's always new brands coming up, always new influencers making their own, beauty products and stuff. So it's always highly saturated and quite an intense industry to be in. So as I kind of mentioned here, they're not just a beauty brand, they are a tech-powered consumer platform, very similar to Hims, to be honest, which has been doing really well as well the last couple of years. As always, we look at a quick abridged financial statement, just to focus on the more key items. So as you can see, the incredible revenue growth, where they had 220 million in 2021, and then by 2027 they're forecasting over $1 billion. As I've already mentioned as well, they've always been profitable, which is a very rare again in these tech, startups and these, small tech companies. So even in 2021 they made a net income of 14 million. This past year they made a net income of 100 million. So obviously, as I always like to do, I like to look at the sector analysis. So I've kind of broken it down into 3 bits. So here are like the typical competitors you expect. These are the legacy ones, and then these are the more direct to consumer kind of companies that are utilizing technology but then selling typical products like clothing or like telehealth for Hims and Hers. So then focusing on the key analysis metrics then, as I always like to look at, is the forward EV to sales, enterprise value to sales, the forward PE ratio, then revenue and earnings growth, which kind of ties into these two, and then the net profit margins, just to see the profitability. From a quick eye check, as I like to do with obviously the color coding blocks, you can kind of see that Oddity Tech is a good positive outlier. So they have 4 green out of 5, which is tied with Elf Beauty as the two top outliers within this whole analysis, which is good to see. Obviously, Oddity does have high valuation in terms of both earnings and sales versus Elf Beauty, but then they also have a slightly higher revenue growth projected and earnings growth projected, and also slightly more profitable. So they actually, when you ignore the valuations in terms of the actual performance, they actually outperforming Elf Beauty. A lot of people probably never heard of Oddity, and so the fact they're actually outperforming is quite interesting. And to be fair, even like when you look at Oddity by itself, the forward EV to sales value of 4.6 is not really that crazy. When you think about L'Oreal, which is a legacy brand, with a market cap of 220 billion, and they have a EV to sales of 4.5, so it's pretty much in line with L'Oreal, to be honest. And then even the forward PE actually is green, because obviously it comes below the sector average when you compare it to the likes of Hims, which has 52, Revolve has 45, Warby has 61. So overall, the valuations I don't think are actually too crazy. Again, when you factor in the really strong revenue growth and profitability of the company, I think you're getting a really high quality company for a pretty decent price, to be honest. So we'll come on to the fair value and price target in a bit, but obviously, as always, we do a SWOT analysis, looking at strengths, weaknesses, opportunities, and threats. You can kind of pause the screen, or again, grab the document for yourself and read into these. Always really good points. And I also then always do a bull case and a bear case. So always useful to understand the upside and the downside risk, and then some additional key takeaways. Technical analysis, always keep it very basic. So obviously it broke out the recent resistance between 47 and 50, and now the new resistance seems to be around 70, but we'll see. But overall quite very obviously bullish, and moving averages also indicate a strong buy as well. Given it's a consumer brand, I also then like doing some Google trend analysis. So with the Il Makiage brand, you can kind of see it peaked actually around, at least the last 12 months, around Christmas, as you'd expect. In terms of then the last 5 years, what I like to do is zoom out a bit more and see how their Christmases and their holiday season went. It was alright. It was kind of in line with 2023. 2022, they seemed to have really good Christmas season or holiday season. But then what is quite interesting actually is the Spoiled Child brand. So this brand actually peaked around end of February, March, which is like super interesting, because then this will feed into the next quarter numbers. So I'm actually expecting to have a really good quarter coming up as well. I think their next earnings call is in August. So I think in the August earnings call, I'm expecting some really good numbers, because their second brand, Spoiled Child, has done really well actually in terms of numbers and trends. All right, coming on to the valuation then. So as always, I like to value companies based on their top line, which is revenue, and then their bottom line, which is their earnings. And then I like to split those valuations between the market and what I believe is a reasonable valuation multiple for each. So for instance, with the market valuation multiples, I always base those on the prior year multiple. So for FY24, with the PE ratio, we get that simply via the stock price at the year end. So at the close of 2024 in December, where stock price traded around $42. The EPS for the year was 1.64. So then obviously simply we get, and then simply from that we then get a PE ratio around 25. So that's the prior year PE here. We then multiply the prior year PE of around 25 by the current year projected EPS, which we have at $2.22, given a price target around $56. With the sales multiple, it's kind of the same thing. In terms of the reasonable valuation multiples, then this is where this section comes in terms of our own evaluation of the company, for our own analysis and everything else we've looked at. So what I like to do then is grab some data from the sector overview, and do a comparison on that. So the more like-for-like ones like Estee Lauder, L'Oreal in terms of legacy, and then the direct competitor being Elf Beauty, Olaplex as well, and then obviously Glossier is a private company, so you can't ignore that. I just was able to get the EV to sales, so I thought I'd plug that in. But I kind of mainly focus on these four then. And then we also factor in their performance highlights. Again, the fact that it has really strong revenue growth year over year, really strong margins, the kind of sector, the kind of technology it has. And then we come to some reasonable valuations based on all this information and data, where I've assigned a forward PE ratio around 35. Again, I think it's on the premium side. When you factor in some of the other, tech-based direct-to-consumer companies, I think 35 is more than reasonable actually. And then a forward EV to sales of 5 as well, which again I think is very reasonable, given the fact that a legacy brand like L'Oreal has one just under 5 as well. So, and their projected growth is nowhere near as high as Oddity's. I think a 5 forward EV to sales and a 35 forward PE ratio is more than reasonable for a company that's growing at this rate. And with that, then you kind of get price targets around 70, so 77 and 71. So when you average all those out, we get a forward price target this year of around $63, representing around a 10% downside, unfortunately, indicating the stock is probably fairly priced as of now. But anyway, I think I've gone on a bit too long there. I'll leave it there. As always, if you have any questions, leave them down below in the description, and I'll try get some.